There are three ways to go to get a mortgage. You can go to a big bank. That's a bank that does everything. It's your Wells Fargo. It might even be a small regional bank, but they're what's called a depository bank. Okay, a depository bank does everything. They take in money for checking and savings. They do auto loans and credit cards, and they do mortgages. Sometimes they're loaning their own money for mortgages, but less often. More often, they're loaning money that comes from the federal government via Fannie Mae, Freddie Mac, FHA, and VA, because they don't need to compete with the federal government for those loans. They can keep the money they have to loan for automobiles, to loan for credit cards. So there is no need for a large or regional depository bank to compete with the federal government. So what's going to happen is, or what happens in that case is you go to a big bank, and the big bank is issuing a loan, but ultimately selling the loan to Fannie Mae or Freddie Mac. That is exactly the same thing that happens with an independent mortgage bank. So Summit Funding is what's called an independent mortgage bank. And what we do, we don't do anything but mortgages. So we will sell our loans to Fannie Mae, Freddie Mac, FHA, and VA, but we also have the ability to get money from these larger regional banks in loan types like jumbo loans, where the federal government doesn't play. Now, the third way that you can get a loan is through a broker. Now, a broker does not lend any of their own money. They don't have their own underwriters. They don't control any of the process. The broker simply says, hey, I'm going to find you the bank. Now, typically, they're going to send it to a depository bank. Sometimes they send it to an independent mortgage bank, but I'm going to find a bank. I'm going to serve as your representative getting the loan done through the bank. So those are the three channels. And let me give you a brief history here. If we go back 20 years, so we go back to 2000, you had all three channels, but the independent mortgage bank was really very, very small portion of the business model. Brokers were really big, and direct depository banks were in kind of a equal footing as brokers. And really what you had up until 2007 is brokers sold the concept that, look, you're better off coming to me. Because as a broker, I can shop all of the different depository banks and find out who's going to give you the best deal. And the truth is, back then, a lot of the depository banks, they were competing with the federal government. They were saying, you know what? You don't need to go with Fannie Mae or Freddie Mac. Come to us directly and we'll loan you our money and we'll do better than them. So brokers had an advantage back then because they could shop through different lenders, but they still couldn't control the process, which is why depository banks still had a good footprint, a good percentage of the business, because look, they were the direct lender. People trusted them with their money as a bank. They trusted them in taking care of them with their mortgage. And so you had depository banks and brokers had the majority of the business. Independent mortgage banks didn't really come into large amounts of business until after the Great Recession. Why is that? Because in the Great Recession, the brokers got cut back a lot in regulation. The federal government, when they passed the Dodd-Frank Financial Reform Bill, really handcuffed brokers and how they could structure their revenue and how much money they could earn and how they had to disclose it to clients. And a lot of people quit being brokers. A lot of the brokers that were in the industry quit the industry altogether. And a lot of people who stayed went to work for independent mortgage banks. Now, you'd think, well, John, what about the depository bank? Many of the depository banks got out of the industry or got out of the business and got out of doing encouraging a lot of business. Chase and Bank of America, being the two biggest, said, you know what? I've gotten blamed for doing bad loans, even though it wasn't my fault, and the federal government has fined me so much money, it's just not worth doing mortgages anymore. And so Chase and Bank of America increased their interest rates, decreased their staffing levels. This is around 2011, 2012, even as early as 2009 and 10. And they said, you know what? I'm going to work with the mortgage buyers and borrowers who want to work with me. I'm not going to go out and try and find people. So I'm going to charge higher interest rates and have less staff. And if you walk into the bank and you really want a mortgage, of course, I'll do it for you. But if you're shopping around for the best deal, we're not going to give that to you because we need to make sure we're making a healthy profit because we're afraid we're going to lose a bunch of money again by getting fined by the federal government when something goes wrong. So that's where independent mortgage banks stepped in. And an independent mortgage bank is simply selling loans directly to the federal government. And for the last 10 to 12 years, independent mortgage banks have really had the largest share of business because brokers were at a disadvantage and big banks, direct depository banks, they didn't want to play in a large sense, with the exception of Wells Fargo. Wells Fargo was still aggressively looking to buy mortgages and be in the mortgage space until January of this year. Now, in January of this year, Wells Fargo backed out, and Wells Fargo said, you know what? We're following the same path that Chase and Bank of America went down. We don't want mortgages unless somebody really, really wants to do a mortgage with us. So the depository bank channel has and especially with what's happened recently with Silicon Valley Bank and with Signature Bank and First Republic, the depository bank's role in mortgages has diminished significantly. So we're simply left with two major players. We're left with brokers and we're left with independent mortgage banks. Now, here's what's happening with brokers. You've got ultimately two companies that have come out on top with brokers, and those two companies are the wholesale companies. Because remember, brokers send their loans to other companies. The problem is the big banks don't want to encourage buying loans. So who's buying the loans? Two major companies have emerged, and that is United Wholesale Mortgage and Rocket Mortgage. Rocket, previously known as Quicken Loans. So those two companies emerged as competitors trying to take over the wholesale landscape. Wholesale being the companies that buy the mortgages from the brokers. Now, remember, I told you back in the early 2000s, the advantage to brokers was that a broker would say, hey, I'm going to shop all of these different banks, and I'm going to find the bank that's going to give you the best deal, and I'm going to send your loan to that bank. And that was still a model, that brokers tell you, hey, I'm going to shop all these banks. I'm better off than an independent mortgage bank like Summit Funding because I can shop a whole bunch of banks. But that really isn't true anymore. And here's why. Because a couple of years ago, UWM, United Wholesale Mortgage, required brokers to work only with them and not with Rocket, or they can't send loans to them at all. And so it created kind of a Coke versus Pepsi world. Tastes great, less filling, the Bud Light commercials from back in the day. It created a war between United Wholesale Mortgage and Rocket Mortgage. And now by contract, if a brokerage says I'm working with United Wholesale Mortgage, they are not allowed to send loans to Rocket. And if the brokerage is working with Rocket Mortgage, they're not allowed to send loans to UWM. So the two biggest players in wholesale aren't really competing with one another on a loan-by-loan basis. They're competing with one another to convince the brokerage to work with them. But once that broker is working with them, that broker is working with them. And what I'm hearing and what I'm seeing in the statistics I'm pulling up is many brokers are sending 80 to 90% of their loans to that company, UWM or Rocket, whoever they are affiliated with. So is a broker really a broker anymore? Is a broker really shopping your loan from one bank to another when 80 to 90% of their loans go to UWM or 80 to 90% of their loans go to Rocket? They're not shopping at all. What they really are is almost an employee of that company, just like I'm an employee of Summit Funding. But they'll tell you they're a broker because, oh, I can shop all around. Well, guess what? They're not shopping around. There are other places they can send loans to, but nobody is competing at the level that they are competing, that UWM and Rocket are. And I really want to tie this into something we all know, which is the airline industry. In the airline industry, you had the price wars between the discount airlines, and you had Southwest Airlines and JetBlue. And it was basically a race where Southwest Airlines says, hey, I'm gonna stop charging for bags. And so JetBlue says, I'm gonna stop charging for bags. And Southwest Airlines says, I'm going to give you this perk for free. And JetBlue says, I got to give you that perk for free too. And so it went back and forth. Now the difference is when you go to get an airline ticket, every time that you go to get an airline ticket, you can decide, hey, do I want to fly JetBlue or do I want to fly Southwest? But when you pick a broker, the broker doesn't get to decide every day, do I want to send it to UWM or do I want to send it to Rocket? And so that creates really a situation where brokers are not shopping your deal. They can send it to a different bank if you have alternative needs, if you have credit that won't get accepted by Rocket or UWM, or you have income that won't get accepted by them, but the rates are higher, the terms aren't as good. The best deal is coming from these two banks. Why? Because they're trying to buy their market share. Southwest Airlines was losing money. A lot of large companies lose money in the beginning because they're chasing revenue. They're chasing market share, even though they won't make any profit. Rocket and UWM are both publicly held companies. What does that really mean? It means they have super deep pockets. They can afford to keep losing money. Okay, I saw the numbers. Rocket in the first quarter of 2023 lost something like $60 million, but they have $900 million of money in assets right now, which means they could lose money for 15 quarters, which is almost 4 years that they could lose that amount of money and still not run out of cash. So what they're playing is a game of chicken. They're playing a game of chicken with each other, and they're playing a game of chicken with the rest of the competition and saying, hey, I can lose money for a lot longer than you can lose money. There's another publicly traded company, Guild Mortgage. And Guild, I don't remember what their numbers were, but I remember very specifically Guild's numbers, they only had 4 quarters of cash. So let's pretend they lost $25 million last quarter, in the first quarter. Then by my math, they had like $100 to $125 million in cash. So that means they have 4 or 5 quarters that they can lose money at that rate before they collapse. And that's what UWM and Rocket are counting on, is getting rid of the competition. So when you think about brokers telling you, hey, I can broker a loan and shop you for the best deal, the truth is they're feeding these large companies. And I get it. I understand what's going on because these two companies are buying the market and they're losing money on purpose. Guess what? If somebody's going to give away potatoes for a penny a piece, I'm going to buy them. They're going to lose money. That's not my problem because look, that's what they're selling it for. I'm going to buy it. So here's what Summit Funding did. We have made the decision that we're going to be hybrid, that we are going to both be an independent mortgage bank because there's a lot of loans that need to be done direct. There's a lot of loans that need an appraiser that we control who the appraiser is, that have property condition issues or credit or income circumstances that need more nuance to them. And that's where, or something needs to get done super, super quick. And that's where an independent mortgage bank shines. But then we have the ability, and we have signed a relationship with Rocket, because you can only pick one or the other. And we are able to be a broker in the exact same way that every other lender is a broker. What does that mean to you? It means to you that when these companies come out with products that are unique, we're able to take advantage of them. One of those unique products is the 1% down conventional loan. So a few months ago, UWM came out with the 1% down conventional loan because it's their way to try and do something that Rocket isn't doing. The problem is UWM's loan was a maximum of a $200,000 loan, and you couldn't make more than 50% of the average income in your county. So it really excluded a lot of people because if people make less than half of the average income, how are they affording to buy a home? And how many neighborhoods in the United States have home prices under $200,000? And guess what? Even in those neighborhoods where prices are under 200, that means the average income is probably pretty low as well. So Rocket came out this last week, which we now have this product that says, hey, we will offer 1% down conventional loan as well. Same thing as what UWM offered a couple months ago, but we're going to make it better. We're going to allow the loan amount to go up to $350,000. And we're going to allow the income to be up to 80% of the area median income instead of being up to 50% like UWM. And we're going to not charge you any mortgage insurance. So Rocket is throwing a bunch of money, simply throwing it away, simply to do better than what UWM is offering. And this is an opportunity that most independent mortgage banks can't compete. We can't throw away that kind of money, but because Summit Funding became hybrid, we have the ability to offer that program. Now, I expect in the next couple of weeks to a month, UWM's going to up and do something different and add something better and throw more money at it to make them look better than Rocket. And then Rocket's going to fire back. You get it? See what I did there? Fire back, Rocket, fire back. Rocket's going to fire back, and they're going to do something different. It's a bloodbath right now, but they both have a bunch of cash. And so, look, my opinion, the opinion of the leadership here at Summit Funding is, look, if they're willing to lose money on every single loan that they do, let's give them more. I don't care, because we will survive long term. We will take care of you, our clients, and our referral partners, and we'll be able to offer all of the different products. And guess what? Nobody can offer everything, because UWM does not let people work with them and with Rocket. So therefore, you're going to be on the Coke or the Pepsi world, and every broker is going to be one side or the other. And now, as a hybrid, we are able to do both. So I know we covered a lot today, but I think it's critically important to understand the changing landscape. Brokers right now have a competitive advantage. Brokers are better right now because they're able to access the money from those two conglomerates, UWM and Rocket, who are racing to the bottom, trying to put everybody else out of business. And the truth is, trying to put each other out of business, so they're the only ones left. And that is an opportunity that an independent mortgage bank simply cannot compete with. And so Summit, having made ourselves hybrid, is a game changer, because we can do both. So when you sit down with me, I'll be able to figure out what's the right product for you, because my tool belt just got bigger. And no matter what the product is that's out on the market, I'll be able to offer it, because I'm both a banker and a broker. And I simply decide which channel you need to go into based upon what your circumstances are.